we are at 10 a.m. on the dot, so we are going to start to move things along here. This is Realtor Unplugged. It is every Wednesday at 10 a.m. Mountain Standard Time. Today we are covering a lease-to-own product that NEXA has available through one of our investors that we partner with. It's the only one that we do. Because if you were here a few minutes ago, you might have heard me kind of talk about that. A lot of the programs that are lease to own tend to be predatory towards the buyers. They're either illegitimate or they're just not a great deal for them as far as what they end up with at the end of the day. If you're leasing to own with the impression that you're, paying towards your down payment and all your stuff, and that's great, but then they take a huge percentage out of the equity when they finally do buy the home, it doesn't leave them with a lot left over. And this program is designed to give them an equitable interest in title. So they have some kind of ownership of the property out of the gate. It's not just a lease to own where they're still a renter and they don't, they aren't able to do things to the home that they would want to do or paint the walls or whatever. So it gives them the freedom to be a homeowner and pay the rent towards the loan, and then also have time to get their financials in order for whatever it might have been that they just missed it by, whether it was a low credit score that couldn't get them into maybe a conventional loan. They need a little bit to get back on track, whether it's somebody who maybe has had a life event and they need to kind of recover from that, and then go ahead and buy on their own. Well, some of us know how that goes. Divorces are always fun. So there's all kinds of, my point is there's all kinds of life situations, right, that this happens, that for whatever reason they're just missing the mark. It's backed by FHA. So what happens is the investor has an LLC that they purchased the home through, and they have the equitable interest given to the borrower or buyer in your guys' case, right? So the good thing about it is what I like is that from a NEXA LO perspective, we almost don't have a way to say no anymore, because if they're not going to be qualified on that FHA loan right away. They're going to be qualified for the lease, and that's pretty easy to do. The credit scores can go down to 580, and they do need to still have their down payment, which generally speaking, I know we have DPAs and things like that as well, but generally speaking, this is people have their down payment 3.5%, and they can still get 6% of the closing costs covered by the seller, which I think is a pretty good deal on that part. And there's no seasoning for employment or assets. So
that's huge.
So if they're going to get what would normally be considered a gift for like an FHA loan, they could get that gift from grandma and use it towards this. And there's no seasoning on it. There's not really a gift letter. There's not all that chaos that kind of goes with that. They'll be able to just go ahead and gift them that now without all of that complications. And then when they go to refinance the home into their own name when they're ready, they don't have to go through all of that again.
And now, Jen, from a realtor perspective, when they are talking to, possible buyers, what is the best way for the realtor to vet them, to say, I have a program that I think we can get you into?
I think it's one of those things that you kind of keep in your back pocket between you and your NEXA LO, to be honest, because at the end of the day, we would rather see, this program isn't for everybody, right? So
right.
I don't think necessarily from a standpoint of an agent, you would want to run out and really do this unless you have in your database people who have just missed this mark, right? Those I would go back to. But your newer clients, I would go ahead and send them to your NEXA LO and get them pre-qualified, because we're going to fish out anything anyway, right? So at the end of the day, and that's partially why I like this, is because when we're pre-qualifying people coming in from that avenue where they're a new buyer, they've talked to the agent's referred them to the loan officer, we have the ability to say, oh, this is not going to work, and then literally pivot and say, listen, this is the option that we have for you. And then what's even better is that program, the way it works and the way they are pre-qualified to go look for that loan, those documents are submitted, the same things that we already have are submitted to the investor for this program, and they qualify everything. They will present the numbers for the buyer and what the costs are ahead of time, and give them their shopping limit ahead of time, which is very close to what a normal FHA shopping experience would be. That doesn't change. They go look for a house to buy just like anything else. It can be a resale, it could be a new build, it doesn't matter. Okay. Which is another nice thing, because if you have somebody who has a new build, and sometimes it's going to take 6-9 months before the house is built, that's great. That gives them some time, but even if it's not enough time, they still have this ability to use this program. And we'll know ahead of time, right? So when you put them in the car, you know whether that's a trio person or not right away, or a link person, as we call that program, excuse me. So they have so on those, actually, it's almost a better deal. And even for the sellers, it's a stronger offer, because your buyer isn't necessarily buying the property. They pick it out, and the investor is the one who buys it for them. And so they're just added to title that way. So the underwriting portion of this is done as far as that goes, because your investor has already have all this is all cleared and set up. So we do go through the process of, once we have a home picked out, the appraisal, you do your inspections, the appraisal gets ordered, title gets ordered, all of that kind of stuff, and it closes the exact same way. So the only difference is doing that up front. If you have somebody that you're going through your database for and you're looking to generate those extra transactions, which is always my favorite thing to say, that's one of those where you're going to send them directly over to the LO and then see if we can't revisit that now that we have it. This is a newly
give new breath into those. Yeah, I like that. We do have a couple questions. Do you want me to ask them as they're coming in, or you want to wait till the end? So Mark Parrish says, does the lease carry the same rules as an FHA loan, such as an occupancy, etc.? Is there PMI? They are paying the mortgage insurance on the PMI. So when they do the finance agreement, is what they call it, with the buyer, right? They will disclose all of that information, including, the breakdown for the actual payment of the loan. There's a couple things that they do have on there to kind of pad things. They do require that there's a premium paid for what did they call it? Payment protection plan was basically what it was. So equivalent of what you see when you get like the small insurance premiums with your credit cards that they offer all the time. Same concept, right? So there's a small amount that goes towards that. That way, if something happens and unexpected, there's protection for their payment that way. It's obviously insured through FHA. When they go to get rid of the loan, they could keep it forever if they want. If they go to get rid of it, they're going to just refinance out of it into whatever they want, right? As far as that goes. And that's something that they can handle with their loan officer whenever they're ready to do that. And are there any time limits, or is it traditional, like your traditional 6 months and then you can refinance?
No, there's no seasoning on it that way. However, there's usually a fee in regards to coming out of that early, almost like a prepayment penalty, right? Okay. So you want to kind of be careful. Like this is, if it's something where somebody's going to want to flip that and maybe 6 months into, if they're that close to it, I would honestly say, unless there's just a house that they just have to have, or they're in a crucial situation where they got to move today, I don't know if I would necessarily say that's a good fit for that program for them, because 6 months really isn't that long of a period of time to kind of just go ahead and get where you need to go on your own. I would say if you're looking for, a standard of what would be a good, as far as what's considered a near miss, I would say it would be somebody that needs probably at least 12 months. So even just on income seasoning, right? They don't require it for the lease to own program, but FHA requires so many years worth of, overtime or commission or whatever. And if you have people who are just starting their careers, or they have a small base salary and it's just not quite going to get them there, and they want to use the overtime, we can use the overtime on the lease program. We can't use it to get the actual FHA loan. So then basically you're looking at somebody who maybe has a year, possibly two, if they just started, where they have to have that commission to get them across the finish line for an actual loan itself. Be it whether that's FHA, VA, conventional, whatever, they're seasoning on all three of those at that point. Then, they have the time to do that. So it lets you take it basically lets you take all the things that would make a loan not a loan and, turn it into an actual buyer.
Home ownership possible.
Yeah. And I know that on the agent side, when it closes, and I say that it closes the same way. So you guys get paid just like you normally would at the close of the sale. So that's also, I know a lot of agents want to wonder about that. So you don't, it's not like you get half and you have to wait and hope and pray somebody 3 years later,
right.
Does what they're supposed to do. You're good at the time of sale. So I know that's usually a plus.
So the realtor does get paid their commission as in a traditional loan at the closing table.
Yeah. The only thing that's any different when it comes to that is that they're always going to be a mail away closing. So they won't do like a title office closing or a mobile notary.
Okay.
In that it's a mobile notary because of the mail away, but they won't do it all in one day. You can't scan the docs back, and they will fund with, without the original documents is what it comes down. So they will FedEx them out, they'll get signed, they'll get them back, then they will fund them. So
but that's still better than having to wait.
Yeah, it's just definitely a coordination moment, but RLOs know that. So they should be making sure that everybody's aware and well practiced and, in timing that closing out and setting those expectations accordingly.
Perfect. And then we have John Estabrook. He asked 580 plus credit score required?
Mm-hmm. Yeah, 580 plus.
And then what is being evaluated in pre-qual if approval regs are more in line with qualifying for rental versus mortgage? So DTI, front end, back end, beyond down payment, what cost is the clients, the buyers, and the tenant responsible for? That's a long question, Tanya.
It's a good question though. So they're going to be responsible for their down payment, their closing costs, just like normal. And then they do require that there's 1% of funds left over of the
purchase price, correct?
If I remember correctly, it was the loan amount, but you could be either way, it's not far off, right? Like, so,
right.
And I would plan on having whatever the value is on it anyway. I mean, having a little bit of a cushion. They just want to know that there's like a month worth of reserves there, basically.
Sure.
Is, more often what it comes down to. But again, the things that they need and in that aspect, they just need to know that they need to have good housing history, right? So, if they've been evicted from somewhere, that's not really going to work. They need to show like they're a really clean tenant. If they have previous rental experience, that's helpful, but it's not required. They can look at it for new buyers that, are maybe just moving out of their home, they're starting their careers, that sort of thing. So we do allow for that rent-free type situation that we see a lot in an FHA loan. They just have to provide a couple of other bills that have 12 months history of being paid on time. So, which is pretty similar to what we do anyway. Like if we were gonna look at something like that, and if somebody doesn't have any trade lines per se, and you're using like alt credit, where you're going to show that they pay their bills on time, they just don't use credit per se, right? So then that's when
and it's always
the utility bills, the car payment, or not the car insurance, that kind of stuff that doesn't reflect on credit.
And to be safe, I think it's always good to have 3 trade lines that you can refer back to show your creditworthiness.
Yeah, and your beginners, a lot of times they just don't know that.
Yeah.
And then there's some people who are they don't want the credit. We know there's a lot of clientele that they don't run on credit, period. They run a lot on cash. And that's another thing, if you have self-employed borrowers, this does work for them, or buyers, that does work for them. And then we would be able to then go ahead and make sure that they're depositing those funds, and we're tracking them, over the next couple of years to be able to financially plan with, to make sure that they're ready to go when it's time. They do keep track of these buyers and leasees as they go along through their journey. So they do help in staying in contact with them, providing the educational tools for financial resources, and, keeping things, in a good place, or getting to a good place. And that's also helpful too. So they don't just disappear on the buyer either.
It's really a constant education on how to get where they ultimately want to be.
It's an opportunity to develop a really good relationship with these buyers at the end of the day. And for me, it's kind of one of those where a lot of these people, when I talk to them, my heart breaks, because, unfortunately on our end of the business, not from NEXA per se, but I talk to people, and it just kills me, because they'll say, I've talked to so many people, and they pull my credit, and then they just won't talk to me anymore. And, or they won't, they just said I don't qualify and that I don't have any business doing it.
Oh.
Okay, well, those are just terrible things to hear as a human. So being able to provide a product that actually fills that need, and then actually helps to build their confidence and educate them in what their future looks like in home ownership, and developing that wealth for themselves is huge, I think. I think it helps a very huge category of people who, for all kinds of reasons, we've had since the pandemic, we've got people changing careers, we've got all this stuff going on, because people are kind of rebooting their lives after, the whole thing. And so this program catches quite a few people, I feel like.
Speaking of that, there was a question. Now, does this work for I-10 buyers?
Yeah. Yep.
Beautiful.
They have to have their employment, and they have to have their letter. Other than that, they're good to go. They just need, we need to know that they're working. Same thing, just pay stubs. Pay stubs have to make sense with the income, assets, and their, history, living history, residential history. So
that's wonderful. And does it take any longer to get pre-approved, like from start to finish?
No, I actually think it's faster. Because in all reality, especially if they're coming in on the front, well, even on the back end, because you've already got all the, they've already sent everything in to us. So for us to pivot and submit it to them, their turn times for getting them approved and ready to go is generally anywhere between 48 and 72 hours.
Oh my goodness.
So you're really talking about maybe just an extra couple of days to turn a no into a yes, which I think is fabulous. And so in that aspect, I think it's helpful too. And then afterwards, because they've already done all of the work on verifying the income, the assets, and the credit, and all of that, we just need a house. So literally at that point, step 2 in the program is ordering the appraisal after the inspection's done, and ordering the title work, and making sure that all comes in and everything is good, and we close. So it's it runs the same term times. They set the expectation of a 30-day close, mostly just because I kind of think that's even just a little bit of an overestimate, because ideally that stuff is done by the time you get the appraisal back, which we're not seeing as much of a struggle with now like we were when things are like crazy busy. So we're getting appraisals back really quickly, and title doesn't generally take that long. And so at the end of the day, you're probably looking at, from contract to closing, more anywhere between 15 and 20 days at that point. So, and again, the seller is in a good place because that's a guaranteed. It's no different than the borrower going and getting underwritten prior to and taking that pre-approval letter. So from a seller standpoint, it's a stronger offer because there is no anymore. The buyer's done, they're vetted.
Absolutely.
That stops that at the property.
As far as the docs for everyone out here, as far as the docs that are needed, that would be something that you want to discuss with your loan officer.
Yeah, we do that kind of heavy lifting.
Yeah.
I mean, and it's the normal stuff. It's the normal stuff. But yeah, your loan officer is going to, and again, because we're pre-qualifying them for a house first, right, to buy on their own, they're going to send us what we need to do that. And so again, it's really easy for us to pivot and just go ahead and say, unfortunately, that's not going to work. However, we do have this option. So let's go ahead and get that set up. And so I think the turn times on those from your LO should probably be pretty quick. As fast as we can review the borrower docs, as fast as they get them to us, right, and get us what we need, we should be able to get that reviewed and know one way or the other if it needs to go that route and move forward. So all in all, like I said, you might add a couple days, 2-3 days to that pre-qualification process.
This is a game changer for sure.
Yeah.
For sure. And Andre, as far as the commission goes, you get paid when they close.
Yeah. You
Same
get all
as
of your
other traditional loan.
Yeah. So if the contract is 3% or whatever between the two of you, it doesn't matter how it's split up. 100% of that goes back to you guys, just like it normally does. No different.
Perfect. And let's see here. Would I-10 buyer? Yeah, I-10 buyers do qualify for this program.
As well.
Yeah. So that, and let's see here. Are interest rate buy downs allowed, permanent or temporary?
So you won't do a buy down on this because, again, the investor's the one that's purchasing it. And so the rates are a little bit different than what you would price out for a regular purchase through like an FHA loan. But they are not unreasonable. I have looked at them and they're a little bit better than, honestly, when you use your DPA programs. Which I know a lot of times these borrowers tend to get shoved into a DPA program, and we have a lot of them with a low score, but then their underwriting requirements are stricter because it has to be per FHA or whatever. And so in this case, again, because you're qualifying them for a lease, it's a lot easier to take that information. You don't have to season the income. If they started the job and they get commission and, we can show that's the commission that they get, then it's income for them to qualify. One of the few things that I think is important to know is that they'll only do two borrowers. So when you have multi-generational families that want to kind of combine resources, which I know is happening a lot all over for all kinds of reasons, be it inflation, aging, whatever, two is the limit. So in that aspect of things, but when everybody's ready and they go to refinance, or do whatever they need to do, if everybody wants to go on the loan, then if that's what they still need, if not, it's probably possible that, income's changed and things have hopefully gotten better for them in that time, that maybe they don't need that. But when it's initially done, it's two is the limit.
It was the limit. Okay. And now the payments that are being made, you're actually earning equity as you're doing this, right? It's not like they're paying rent where it's 100% interest.
Right. So part of that payment is going towards the actual payment. That's always broke down the same way it always is, right? Principal, interest, mortgage insurance, taxes are covered, all of that. The HOA has to be paid by the buyer separately as its own bill. But other than that, everything else is all included in that rental payment. And then along with that, the payment protection. So they do require that. And again, and I think that in that aspect, again, it's there as a safety net,
Sure.
In case something happens. And I don't think that's a bad thing. I mean, when you have somebody going in and a lot of these borrowers, especially when they're younger buyers that are trying to buy, their resources are more limited. And so being able to develop some more savings and to be more prepared to own the home outright would be a good thing. But as far as the actual cost of like something breaking or whatnot, those are all covered within the finance agreement. So.
Gotcha. And that agreement, of course, we're going to have an established amount of what you're purchasing the home for in those documents. So it's not just like an open-ended, well, this could change at any time, correct?
No, it's very drawn out.
Like they used to be.
Correct. It's when I say that it's a finance agreement like that, it's literally like it's another contract that they're signing. It's a lease.
Sure.
And it has all of those legalities, every single one of those numbers all put together in there. This investor is very transparent with it. They're not trying to hide anything from these buyers at all. I've worked with them for a minute, so I know firsthand that they go out of their way to be very transparent about it, and their goal is to get people into a home. They do not want to watch somebody fail, and that's part of that protection plan, right? That's another thing, like with your other programs, and I say that loosely, but you see these other lease to own options, and they're really more designed to wait for that buyer to fall down so that they can just take the house from them and the equity and go. Like, it's designed for them to fail. They're just hoping for it. Whereas in this program, they are truly wanting them to take the house and own the home and be homeowners. It's designed for that, and the intention of it is for that. They don't want to hold real estate.
Okay, and now Ivan Martinez said, we have some special rules in Texas for lease options. Does this work in Texas?
Yep, it does. There's only a couple places where we can't do it. One of them is we don't do New York anyway, but one of them, the areas that they can't do it in is in your really suburban areas of New York for all kinds of reasons. There's all kinds of land leases and townhomes and brownstones and all the co-ops and everything. And it gets just really messy really quick. So they don't do that area. And they do not do flood zones. If the home is located in a flood zone, which is something that we should be able to clarify on pretty easily, and or an insurance agent is going to be able to tell you really quickly. If so if the buyer is interested in a property and you're questioning whether it's in a flood zone, if they have an insurance agent that they like, great. If they don't, log into support and ask your loan officer to take you over to our insurance team. They'll be able to look it up and give you that answer right away, live on the spot, just like this.
They are phenomenal too.
And so that's an option to be able to kind of vet that out. Most of us know whether we're in a flood zone or not. I know some of that has changed in certain areas of the country though lately, with just the kind of changes in weather and floods that have happened. And so you kind of know where those areas are, and you would know whether to check. I'm in Phoenix here. It's not really necessarily an issue, even though I always kind of advise having it because we have flash flooding and whatnot. And I've seen it happen where it's gotten, it's flash flooded and it's gotten high enough where it's, soaked the bottoms of some people's homes. We haven't come nearly close to anybody floating around with furniture or anything.
Right.
It can happen,
in California,
right?
Who would have thought that we were in a, state of emergency with
correct,
rains?
exactly.
We've been in a drought for so many years.
Yeah. Yep. And so,
Better be safe than sorry.
yep, absolutely.
We have a bunch more questions, but we are running short on time. So what I would suggest is, first and foremost, our apologies if we don't get to your question, but just know that you can log into loanofficersupport.com at any time and get your questions answered, or just go back to your loan officer. Mm-hmm. We provided them with some great information on this program yesterday. So again, my apologies if we don't get to your question. Jen, do we have time for a couple more?
We can do one or two more, and then we'll probably have to, unfortunately. But again, like I said, and then also though, I want to make sure that we cover for next week, because logging in will get a lot easier next week because of the announcements that we have for mortgage support. You guys are gonna love it.
Yes, mortgage support is going live.
Which means you'll be able to log in. You'll have a loan officer live again, just like this, ready and waiting to have a conversation with you. If you need a second look on something, if a pre-qual looks fishy, and you're not comfortable, we will do a second review on those for you. And your buyer, if you're coming straight in looking for your regular NEXA LO, they will be able to be there for you face to face and go ahead and help with dealing with applications and qualifying a borrower, and all the way through, and spot on for the most part.
And the best part of it is it's free
99. Yeah.
We just want you guys to have the best experience. And NEXA can provide that to you. Yeah. You'll see once you start logging in. The talent that is within the NEXA umbrella is just unsurpassed. Yeah. So you'll be able to log in free, get your questions answered, and it just doesn't get better than that.
So we will actually have Mr. Mike Cordes with us next week, because he wanted to personally come in and announce this and present it to you guys to roll it out. So it is rolling out next week, and we're super excited about that.
Yes, we can.
All right, just a couple more questions, and then we'll.
What's the approval amount based on? Is it 3 months? 3 months rent?
The loan?
Yeah.
What was the question again?
What is the approval amount based on?
It's based on their DTI more than anything else.
Okay.
So, and it doesn't, cut them away. It was 35, 42. It's pretty normal what's there. So, I mean, if somebody is really overloaded in like credit cards and nonsense, it might be a little harder to get that straightened around with them. They might have to pay some of that down first. But again, they're going to know that before you put them in the car. It's not going to be a conversation that happens later. So, obviously at any time you have a buyer that wants to come in and start shopping for a house, you always want to get them pre-qualified sooner than later so that you know all that up front.
Absolutely. And now I guess I'm going to take this one last question. Is there restrictions for, let's say, like rural areas or maximum acreages? Acres, I should say.
Yeah, the acreage, I believe has a limit, but it was larger. I'd have to double check and clarify. I would ask your regular loan officer, because they have that right in the guidelines, and they have those guidelines. The other one, the one thing that they won't do are the no mobile homes on property. And so that's, obviously, but everything else that is a normal FHA home, approvable home, and it does need to have, the regular safety, all that stuff applies, right? Some repairs, as long as the seller is willing to do them, that shouldn't be an issue, just like it normally is. If the seller's willing to fix them, great. If they're not, then maybe that's not the house, right? We all know how that conversation goes.
Absolutely.
Nobody likes appeals on the appraisal, but
yeah.
we all know it happens. So other than that, it is 10:34, so I'm going to wish you guys a good week. We will be back next week at 10 a.m. Mountain Standard Time. I will fill in for Dan and tell you that it's going to be the same bat time, same bat channel. And you guys are all free to go roam the country. Have a great day.
Wonderful. Thanks so much, guys.
Bye-bye.
Bye.